The world of investing can seem very mysterious, with strange terms and concepts like buying the dip. What does that mean? If you're just getting started on your investing journey and you've been searching for investment advice on YouTube, seeing tons of videos about things to buy, when to sell, buy low, sell high, whatever other thing that you've seen, and you're absolutely confused, this is the video that you need to watch. In this video, I will break down in very elementary terms the 101 of investing. Successful investing does not require advanced or complex mathematics or models. Most people just need to understand the basics, and you are well on your way to building wealth through investing. This video is going to be broken down into 7 segments. Number 1, I'll go through the basics of investing. Secondly, I'll talk about assets, returns, and types of investments. Thirdly, I'll talk about risk. Fourthly, I'll talk about the power of time in investing. Number 5, I'll talk about costs and taxes. Number 6, I'll talk about market behavior, how the market reacts, what market behavior is, and what to do based on what the market is telling you. And number 7, lastly, I'll tell you how to get started investing today. Let's jump right in. Starting with the basics, number 1, let's talk about what is investing and how is investing different from savings. Saving is putting money away for short-term needs. Most times you put the money away in cash and it will be in a bank. It is easily accessible to you whenever you need it. Whereas investing is taking your money and turning your money into a workman for you. It is putting your money to work and expecting it to bring back to you returns. Think about it like savings is parking your car in a garage. Investing is taking your car to work. In both of them, you have a car. You have your money, your cash. In savings, your money is parked somewhere. In the case of investing, your money is being used to generate returns. Why should I invest? You should invest instead of save because your money just parked somewhere is not safe, actually. Your money parked somewhere doing nothing is actually losing value. The value of money is not just the amount of money on a dollar bill. So you have a $25 bill. Yes, the value of that money is not just $25. The value of money is the purchasing power that money brings you. And the thing about purchasing power is that purchasing power changes over time because of something that we call inflation. Inflation basically is the increase in price of goods and services in the economy due to the different things that happen in the economy. The inflation rate is always rising. Well, it rises most of the time. And that's why you may hear stories like in the past, $10 used to be enough to feed a family. Now, $10 is not enough to buy a meal. Is why $10 has not changed. $10 is still $10, but the purchasing power of $10 has changed over time. So you may have $1 million sitting in a bank. Great, good for you. You are a millionaire. However, what your $1 million can buy today is not the same thing as what your $1 million will be able to buy 5 years from now. So by investing, you should be getting a higher rate than inflation. So that way, number 1, you preserve the purchasing power of your money and you get some return on top of it. So let's assume that inflation rate is 2% and it's not. And you invest your money in something that provides you a 10% return. By putting your money in that instrument for 1 year, what are you doing? You are ensuring that at the end of the year, your 1 million at the end of the year will be able to buy you what 1 million can buy you today because your return on the investment, 10%, is above the inflation rate of 2%. So your true return is actually 8% because 2%, is going to help your money catch up to the purchasing power 1 year from now. And then 8% on it is return for you. The money has gone to work and it has brought back a return. So that is why you should be investing and not just saving. When is the right time to invest? Today, as soon as you can. Immediately you have the extra money to invest, you should get started. How much do I need to begin investing? You can start investing with as low as $10, $100, $500. There are many platforms that help you, allow you invest with even things like $5. There are apps that allow you buy a fraction of a share and you can buy it in very tiny amounts without spending hundreds or thousands of dollars. Moving on to the second section, assets, returns, and types of investment. What is an asset? An asset is something that you own that increases in value over time. And the opposite of an asset is a liability, which is something that takes money out of your pocket. In the investing world, assets include things like cash, stocks, bonds, real estate investments, and other type of securities that exist in the markets like index funds, mutual funds, futures, call options, things like that. Those are all assets because they have the potential to put money into your pocket. Now, each of these assets, they're all different. They have different returns and they have different risks. So let me break down what we know as asset classes. And I'm going to list this out to you in order of increasing risks. There are broadly two types of asset classes. There are liquid assets and there are illiquid assets. Liquid sounds like the name. You can easily pour it. You can easily transfer it from one container to another container. Think about pouring water from one bottle into another bottle. Whereas illiquid assets, as the name implies, they are illiquid. They are not easily transferable from one pocket to another. Now, what are liquid assets? A good example, which you probably already have, is cash. Cash is something that is easily transferable. You can withdraw your money from the bank today and put it in another bank tomorrow. It's very easy to move it around. Cash is actually an asset. And the returns that you earn on cash right now is probably like 0% to 5%. 0% if you put it in a bank that has zero returns on your savings. Or as high as 5%, last time I checked, if you put it in a high yield savings account where some of them offer like 4.5%, 5%, and this is just cash. However, cash is the lowest risk and it has the lowest return of all the liquid assets I'm going to talk about in this video. Second category of liquid assets, in order of increasing risk, are bonds, or I'll say broadly, money market securities like bonds or treasury bills. Bonds are basically loans that you give most times to the government or to a private company. And because it's a loan, it has a lower risk because many times bonds are backed by the full faith of whatever institution is issuing it. To issue a bond, most companies will need to have what you call a bond rating, and that bond rating is based on the company's financials, the company's history, and the higher the bond rating, obviously the lower the risk. If you put your money in a bond, the risk of losing your money are very low. Now, bonds are liquid, but they are more illiquid than cash. Most times you have a lock-in period, a period in which you put your money in the bond, you invest in the bond, and you cannot withdraw your money out until that period elapses. The return on bonds is also higher than cash because you are bearing some risk because you are giving your money away. Another level of illiquid assets is mutual funds and index funds. Mutual funds are a basket of securities. When we say securities, I mean here like stocks. Stock is a share of a company traded on a public exchange, and I'll get into that later. But a mutual fund is a basket. Think about it, it's like a basket where you have different stocks. So by investing in a mutual fund, you are essentially investing in a multitude of stocks. Now, this has lower risk because you're investing in a multitude of stocks. So if one stock performs poorly, the other stocks in the mutual fund would, help to cushion that effect. So if you select a good enough basket, all the stocks in the basket will not be performing the same way at the same time. So you may have one stock performing poorly and that one performing well, keeping your money at like a level average. Whereas an index fund is the same as a mutual fund in the sense that it is also a basket of securities. However, an index fund is traded like a stock. So, and a good example of this is like ETF. It's called exchange traded fund, right? It's basically a basket of security that is traded. It has higher risk, but it is still lower risk than some of the things I'll talk about later on. Then the last one under liquid investment is stocks. And when we talk about investing, this is the first thing that they think about when I want to buy a stock. Buying a stock is essentially buying a share of a company. So if you buy Apple stock, you are a part owner of Apple. However, the size of your stock obviously determines the size of your ownership of Apple, but by buying a stock, you are investing in a company and you are a part owner of the company. Now, by buying a single name stock, so buying Apple or buying Tesla, you are exposing yourself to the risk of that company. If that company receives indictment by the government, some regulation comes up impacting that company's goods or services, the stock is going to go poof down and your money is going to go poof down with it. On the other hand, if the company has a successful launch, they launch a new product, they launch something new in AI or something like that, and the stock is rising, voila, you make a lot of money. You can buy stocks of publicly traded companies. So not all companies are publicly traded. For a company to be publicly traded, it needs to have listed itself on a stock exchange. In the United States, you have the New York Stock Exchange, and you have the New York Stock Exchange, and a lot of companies are listed there. Most of the big companies that you know are listed on the stock exchange: Apple, Google, Tesla. Now moving on to illiquid asset classes. These are asset classes, as I said, that they are more difficult to get into and to get out of. The good thing about liquid assets is very easy to get into them and also very easy to get out of them. The first illiquid asset I'm going to talk about here is real estate. Real estate basically is things like houses, lands, farmlands, just real estate, things that, they're real. You can touch them. The estates, real estates. Investing in real estate basically is investing in some form of property, house or land. And there are many ways you can do this. You can invest in property directly. You can buy a house or buy a land and rent out the land, and you could lease the land. Someone could use it for like a filling station. Someone could use it for farming. Buy a property and you can rent it out and rent on the property. You can live in it yourself and earn return from the value of the assets going up. Or you can invest in something called a REIT, R-E-I-T-S, Real Estate Investment Trust. This works like a mutual fund where you are not directly buying the real estate, but you are buying a security of the real estate. A REIT is like a maybe basket of real estate, but you are buying an interest in that real estate property, but you're not doing it directly. You're doing it through a REIT. And REITs trade like stocks, so they're actually more similar to the index fund, and they pay out about 90% of their return to investors every year. So if you're an absolute beginner but you want to get exposure to real estate, I would recommend that you start with a REIT first before deciding to buy a property as an investment instrument. Another type of illiquid investment is hedge funds and private equity. Yes, private equity, I know, is a career, very popular career if you're familiar with the world of finance, but private equity is also an asset class. There are people who invest their money in private equity. Most times these are millionaires, multimillionaires, and billionaires who have a lot of money that they have more money that, they cannot invest directly. Like investing directly in a stock is not enough. They want to diversify their return. So private equity is the opposite of public equity. When you buy stocks, that is public equity. That is equity in companies that are public. But if you want to invest in a company that is private, that is private equity. And you can even do that by investing in your friend's startup. You have a friend right now who is working on a startup. You believe in what he or she is doing, and you give your friend, some form of money for their startup. Hey, congratulations, you have become a private equity investor. Yes, venture capital is a subset of private equity. These asset classes are typically exclusive. For example, hedge funds, you need to have a minimum amount of wealth to be able to invest in these asset classes because they are risky. You literally can lose your money. You can lose all your money. If you put your money in a startup, it can go down to zero. So step one is you need to have a minimum amount of wealth. Most of these asset classes are reserved for HNIs, high net worth individuals, and you can Google that. There is a definition, a particular net worth that you need to have to be able to qualify to invest in that. You need to be a qualified investor. Private equity funds gather money from high net worth individuals. They invest in a company. Many times they take over the company and they restructure the company. They may change the way the company goes to market. They may improve something in the company's operation, and they turn a profit. Now, this also has higher returns. Illiquid assets typically have higher returns because it's high risk. So you can have as high as 50%, 100%, 200% return. Like imagine you gave Apple or Facebook some form of startup investment when they were beginning, and look at how massive they've become now. The payouts are ridiculous. Another illiquid investment here is commodities. So commodities like physical gold. Yes, you can trade gold. You can buy gold and keep it in your house and hold it for many years and sell it after a few years. So you have things like gold, crude oil, agricultural products. These are illiquid investments if you want to buy the actual thing, like you want to actually buy gold, or you want to actually buy crude oil, or buy some agricultural product. However, thankfully in the United States, you have securities that allow you to trade commodities. They're mostly called futures. You can buy commodity futures that allow you to trade these commodities without actually buying the commodity. So instead of buying gold or buying crude oil, you could buy crude oil futures or gold futures. Again, these are riskier because you could lose your money. You are essentially making a bet. Let's assume that you know that, or you are sure that something's going to happen in the crude oil or oil and gas industry in a few years. You can buy a commodity future based on your belief, based on your expectation. And if your expectation comes true, you earn the reward for having the foreknowledge or forecasting it. And if your expectation does not come true, well, you lose because you made a wrong bet. So these asset classes are more advanced than a beginner. Consult your financial advisor for specific financial advice on what to invest in. But just for your awareness, whenever you're listening to investment news and you hear things like commodities or hedge funds or whatever, now you have a better understanding of what they are. So let's talk about returns. How do you make money from investing? The reason why we invest is to make money anyway. And there are two ways you make money from any type of asset class. The first one is dividend or payout. So you invest in a stock, as I said, you invest in, let's say, Apple. You are a shareholder of Apple. At the end of the year, when Apple does its business and they make money, they may share a dividend. So they may actually just give you money from the profits of the company because you are a part owner of Apple. And the second way to make money is through increase in the value of your assets. Assets, as I said, are instruments that can increase in value. A good example is gold or stocks or something. You invest in Tesla when it was just a young company and the price of the stock was, let's say, $20. But over the years, Tesla has grown. They have increased, introduced more products. There have been things in the environment like regulations that have come up that has made the value of Tesla go up. What you will notice is that the price of your stock will go up. So let's say you bought a stock for $20. You could see that after 5 years, it's now trading at $400, for example. That is a return. How do you lose money? You lose money if the value of your asset drops. So let's say you bought a stock for $20, but after a few years, nothing happened, and now the price of the stock is now $10. If you sold your stock today, you would have less money than you put in. So each of these asset classes that I mentioned, starting from stocks and below, you could lose money. Moving on to the third bucket, which is risk. Any form of investing involves risk, and risk is a normal part of life. Everything in life involves risk. When you fall in love and get married, you're taking on a risk. When you take a job, you're taking on a risk. When you buy a plane, you're taking on a risk. The same thing with investing. When you invest in anything, you take on risk. Now, fundamental law of investing is the higher the risk, the higher the return. And risk depends on what you invest in. As I just explained to you now, some things are more risky, some things are less risky. Bond cash, they're less risky. Real estate is also a little bit less risky. But things like futures, options, stocks, they are more risky and they also have higher return. The way to manage risk, you cannot completely remove risk, but you can manage your risk by what is known as diversification. You probably heard this comment, do not put all your eggs in the same basket. It's the same thing with investing. By diversifying your investment, you are reducing your risk. A good example of this is instead of putting all your money in tech stocks, you could put some money in tech, some money in, oil and gas, some money in agriculture, some money in different industries, because each of these industries have different risks. And some industries are higher risk than the other. For example, technology is a high risk industry to invest in compared to something like agriculture, which is more stable, or things like food. So diversifying is a way to spread out your risk, make sure you don't have all your eggs in one basket. Now, when you're investing, what's the best way to think about risk? In portfolio management, there's a concept called risk assessment, where you help a client understand what risk that they can take. And how do you do that? We do that by assessing two things. Number one, we assess what is your risk appetite. And number two, what is your risk capacity? Your risk appetite is basically like an appetite. how much risk can you stomach? Some people are risk takers, right? They are looking for the thrill. They have appetite for risk. And what I mean by appetite is like, if you lose $100 in the stock market, how would you feel? Okay, if you lose $1,000, if you lose $5,000, how would you feel? That's how you assess your risk appetite. If you know that if I lose $8,000, I will be sad and depressed and I'll probably fall sick. It's better for you to assess where your risk appetite is. Second thing is, what is your risk capacity? You may have a high risk appetite but have a low risk capacity. And your risk capacity basically is how much risk can you realistically endure, right? You may be able to lose money and it will have no impact on your net worth. So let's say you have $1 million net worth. You live in your own home, you have your own car, you have a stable job, right? If you lost $1,000 in the stock market, you may feel bad about it, your emotions may be hurt, but your life will not be destroyed. You know, you will still have a job, you still have a car, you still have a house, you still have food on the table. So your risk capacity is probably higher than $1,000. Whereas if you lost $500,000, that may affect your life, right? You may have to downgrade your lifestyle, downgrade your car. You may default on some bills. So that is what risk capacity is. Let me give you another example. Let's say you live in an apartment, you pay rent, you have a regular job, and your rent is like $3,000 a month. And then you put your money in the stock market and you lose $3,000 a month. That may impact your ability to make rent that month. So your risk capacity is definitely lower than that. So it's a balancing game. How much risk can you stomach? What's your appetite? And how much risk can you bear without you having a loss to your quality of life? How much risk you go for in the market should depend on your goals and your timeline. If you are investing for a short-term goal, let's say you want to buy a house in the next 2 years, and that's why you are investing, it is not wise for you to put your down payment into risky securities like single name stock, because anything can happen to your stock and you could lose your money. So if you have a short-term goal, it's better for you to put money for short-term goals into safer securities like high-yield savings account or bonds or something like that. Whereas if you have long-term goals, right, let's say you're 20 and you want to use the money when you're 50, so 30 years from now, with that kind of money you can take risk, because most times markets always revert. If you lose money today, you will get money tomorrow. Technically, tomorrow may come 5 months from now, but one day the market will not always be down, and then over time the returns would average out. So the longer term your goals are, the more risks you can take. As well, also consider like where you are in life. Like you just moved to a new city or a new job, or you just got married, or you are in some form of precarious, tricky situation. That may not be the time for you to take risk. Welcome to the fourth section, the power of time. When you're investing, many things are your friend. Your money that you're investing is one thing that you need. The return, the risk is another thing that you need. Another part of the puzzle is time. You've heard this saying, time heals all wounds. Well, time is something that we're going to recruit in investing. The longer you hold an asset, the higher the return you will get from that asset. Holding assets for a long time allows you to benefit from risk-adjusted return over time. As I said, investing in the stock market, let's say you put money in the stock market today and it went down and you lost money and you withdrew your money. That's fine. You've withdrawn your money, but then just know that most times market reverts. There's something that is called mean reversion. Market will always revert back to their baseline. When the market goes back up, you've already taken your money out of the stock market and you're not able to participate in that market upturn. And now if you want to enter the market back, you probably will enter at a higher cost. And this is where compound interest comes in. Compound interest is a blessing. Compound interest is the OG of investing. It's basically you earning interest not only on the money that you invested, but on the interest that you have gotten on your money. So let's say you invested $2,000. Simple interest is you just keep earning a return on $2,000. But compound interest is, let's say you are earning a 10% return. Today, you earn a return on $2,000. A year from now, you earn a return on $2,200. And a year from now, you earn a return on 10% of whatever that money is then. So you keep earning money on your initial investment as well as your interest. And that is amazing. Imagine you put in $100,000 what will it be in the next 5 years, in the next 10 years? That's the power of compound interest. But you can only take advantage of compound interest if you are willing to play the long game. If you're willing to put the money in the market and forget about it, put the money in the security and allow compound interest to do its job. Allow time to take its course. With this in mind, once you start investing, how often should you be looking at your portfolio? Don't look at it every day. Leave it alone. Let the market do its thing. There's a concept that is called dollar cost averaging. This is where you automate investment into your account periodically. So let's say you automate $500 into your asset class, periodically. What dollar cost averaging does for you is that it allows you to enjoy the adjusted return over time. So when the market goes down, it's fine. You will buy at a low price. When the market goes up, it's fine. You buy less securities at a higher price. When should I sell my investment? Sell your investment when it feels right for you. Let's say, again, you have a short-term goal and you need money to achieve that goal. You can go ahead and sell. But do not try to time the market. And this is where type of investors come in. There are two types of investors that you see investing. There's the active investor and the passive investor. The active investor is like your trader, your typical day trader. The person wakes up in the morning and checks what is the market saying. And they try to time the market. They try to forecast the market and say, hey, market will go down, in a month. Market will go down in a week. How should I respond today? Or, the market is down. Let me buy more. Buy low, sell high. Let me buy more now when the market is low, and then I'll sell when the market is high. Or they'll be like, this stock is $200. I think it will go down in 3 months. Let me sell now while the market is high. Now, these are some people. These are their day jobs. They're people whose jobs are to trade, and they do try to beat the market. Active traders do not always outperform passive investors. Passive investors are people that just put their money in the investment and then hands off, and then they let the market do their thing. An example of that is the popular billionaire that we all know, Warren Buffett. Warren Buffett just invests money and he hands off. He's not trying to day trade. He makes money moves or investment moves when there's a material shift in the fundamentals of a company, and that's what is called value investing. And I recommend you to, it's a tried and true method. Warren Buffett is a billionaire, so his results are visible for all of us to see. And I can make a video about value investing. If you'd like to learn more about it, let me know by commenting value investing in the comment section below. If you are just starting out, I do not advise you to try to be an active investor. I advise you instead to be a passive investor and let the market do its thing. Fifth, cost and taxes. One cost that you will bear in investing is just trading costs. So if you decide to use a platform to invest, you may have platform fees that the platform will charge you. You may have like account management fees. You may have trading fees. So be aware of that when you are investing and don't be shocked. Another one as well is tax. You are taxed on your returns. You are taxed on dividends and you are taxed on capital gains. And there are two types of tax. Your return on investment, so that's dividends that you get from investment, is taxed at your ordinary income rate. So if your ordinary tax rate is like 30%, that's the same tax rate that you will bear on your returns by dividends or cash payout. Whereas if you have capital gains tax, capital gains basically is when you buy a stock at 20 and then it is 200 now and you are selling at 200, so your gain is 180. 180 is your capital gains. You will be charged at the capital gains tax rate. So just putting it out there so that you are not shocked by it. When you're calculating your effective return on investment, you need to back out these costs and this tax, and so you can know whether it makes sense for you to continue on a particular investment strategy. Number 6, let's talk about market behavior. One thing you need to know about stock markets is that stock markets are forward-looking. Stock markets try to forecast what they think the future of a company is. So if a company stock is trending downwards, what it basically means is that investors, the general investing market, think that this company's future is at risk. If a company stock is generally trading upwards, it means the opposite. The market, the investors think that this company has a future and has a great potential. So they are trying to invest because they are expecting positive return in the future. So markets are forward looking. With that in mind, how do you respond to market behaviors? What do you do when you see the market going down? When the market is going down, it means one thing: people do not have faith in the future value of a company. Now that's the general mindset. Another thing about the market is that the market follows a lot of herd mentality. If one person starts buying, most times most people will start buying. If one person starts selling, most people will start selling. The market tries, most times they follow each other. And when you're investing, that's the wrong strategy. The wrong strategy is for you to follow the market. When the market is low, when the market is selling, you sell. When the market is buying, you buy. That is not the right strategy, because following the crowd is not always the best strategy. It's always good for you to form your own independent opinion of the market and of a security. So you may see a stock trending downward, it is red, it has lost money. It doesn't mean it's time for you to sell. It's only time for you to sell when you, based on your research and your assessment, think there's a fundamental shift in the value of the company. Common investment that most people make, again, market behavior is number one, chasing hot markets, chasing hot stocks. You just wake up and see that, people are buying XYZ stock without understanding the fundamentals. You have no understanding of the industry, of the product, of the company, you just buy. That is wrong. Following the market or chasing the hot stocks is always a bad strategy. And that one is trying to time the market, trying to play the game. Except you are trained as a trader. And there are people who do this as their day job. And they have computer programs, they have PhDs in math, and they are well skilled. They have years of experience in timing the market. And that mistake is just not diversifying. Putting all your money in one stock. That's wrong. Imagine putting all your life saving in one stock. If anything happens to that company, boom, goes your investment. Do not do that. Always diversify. Diversify across industries, within industries, across geographies, across asset classes. As many types of diversification as you can get, diversify. Another mistake is ignoring fees. Investment fees can easily rack up. If you're always trading, always buying, always selling, always buying, always selling, you will be amassing a lot of fees. And these fees can eat into your profit, which is also why you want to, make sure that all your moves in the market are very well thought out. And then last mistake is using your emotions. And I'm going to make a video on this channel about some of the emotional biases that investors face. So using your emotions to buy things is never the right strategy. How do you get started investing? The first thing is to choose a brokerage or investment platform. And when you're choosing a platform, you want to look for one that has low fees. As I said, fees can easily rack up when you start investing. So look for one that has low fees. Look for one that is easy to use, that has a nice AI, easy to use. You like the way the platform is designed. If you're an absolute beginner, you've never invested before, you want to look for one that is not complex, one that breaks things easy, that makes it easy for you to invest. And you want to have one that has good customer support. If you have a question, can you ask anybody right on that platform? And there are many. You have things like Robinhood, Vanguard, Fidelity, SoFi. They have different user-friendly apps. You can try them. I will make a video about reviewing some of these apps sometime soon. If you want to see that, definitely subscribe. Another thing as well is robo-advisors. You have robo-advisors like Betterment or Wealthfront, and these automate your investing, right? When you sign up, they ask you a bunch of questions about yourself, and based on your responses, they automate investing for you. This could be a good way to get started if you're trying to do it yourself and you are an absolute beginner. And even if you're not ready to start investing, you can begin to learn about investment by just paying attention to investing news. Things like Yahoo Finance, Google Finance, these are places that you can go, see what's happening in the market, form your own independent opinions, so that whenever you're ready to start investing, you can hit the ground running. Now, before you start investing, I always recommend people to have 3 to 6 months of emergency fund saved up, max out your retirement account, and then whatever is left, begin to invest, and then invest by using index fund mutual funds before you go into stocks, futures, options, and other more complex investment strategies. If you want to learn about how to make a financial plan, right, where you need to plan out what would you invest, how would you invest, where would you get the money to invest, then I have a video here that is titled How to Make a Financial Plan that will be helpful to you. Thank you for watching my video, and I'll see you in the next one. Bye.